So with you today is Professor Troll. Welcome all again. I will be trying to explain today IAS 10. For those who are not familiar with IFRS, I will try to explain it in an easy way. So let's start by basically an example. So usually companies close their books on 31 December. So this is the year end. Following the year end, you'll have auditors who will be coming and will be checking your accounts till the date your report will be signed actually. So it might happen that by this date we are already in April. So usually these events between December 31 and April in our example, those are the events that are covered by IAS 10. We have two types of events, the adjusting ones and the non-adjusting ones. So what's the difference between the two? The difference is as follows. For adjusting events, we need to go back and adjust the figures by 31 December. So we need to book the amount related to this adjusting event and to make as well a disclosure. For the non-adjusting events, it's all about two things: materiality and disclosures. So this is an S, so it's disclosures. So as I said, we have two types of adjusting events. The ones that are subsequent events, sorry. We have two types of subsequent events, the adjusting ones and the non-adjusting ones. I will give a simple example, which is very known in the accounting industry, which will show you the difference of what is an adjusting event and what can be defined as a non-adjusting event. So for adjusting events, we have usually the following example. You have a receivable at 31 December 2019 related to a customer you have. This customer on 15th of January declared bankruptcy. So is this an adjusting or a non-adjusting event? As per IAS 10, this is an adjusting event. Why? Because the event itself of bankruptcy couldn't have happened only in the last 15 days, I mean between 1 January and 15 January. This event already existed as of 31 December 2019, for example, and accordingly, this is an adjusting event because the root cause or the event itself was already existing as of 31 December. I will change the scenario right now, and let's say the same customer for which I had a receivable as of 31 December 2019 declared bankruptcy as of 15 January 2020. But the reason is because a fire destroyed all his facilities. So as per IAS 10, this event and this sudden event cannot be related to 2019. The event by itself happened in 2020. And for this same reason, I don't go back and adjust for the provisions as of 31 December 2019. I don't book a provision on this client. I just need to disclose this fact in my financial statement and say, okay, if it's material, as we said, if it's material, we'll just disclose this event and say, okay, this client, which is material to us, has gone bankrupt following year end. But I will not go and adjust my figures as of 31 December 2019. If you can grasp these two examples and the difference between it, you will grasp all the concept of IAS 10 actually. So let's go to some exceptions defined in IAS 10. We have the concept of going concern. This concept is part of the conceptual framework of IFRS. So basically all the financial statements as per IFRS should be prepared actually under this assumption. This assumption defines that the company will be continued to operate in the foreseeable future. So under this assumption, the financial statements are prepared. So now how can we correlate or relate the conceptual framework definition of going concern and what has this concept to do with IAS 10? So basically, if the financial statement I'm preparing or the company in which I operate or for which I prepare the financial statement between December and April assess that it is not capable to continue on a going concern for any event, whatever it is an adjusting or a non-adjusting event, I should go back and prepare my financial statement on an ongoing concern basis as of 31 December 2019. So the going concern is an exception. So whenever I found between the date of the balance sheet and the date I signed my financial statement that my company might not operate or will cease operation in the foreseeable future for whatever reason, I don't need to assess if this constitute an adjusting or a non-adjusting event. I should go straight back and prepare the financial statement under the assumption that this company will not continue to operate, so it will be under an ongoing concern assumption or under a liquidation basis. The second concept is dividends. So here we need to understand how IFRS treat dividends, distribution of dividends. So the policy is as follow. So dividends are always recorded when they are declared. So you never book a liability or a liability for your dividends unless it is declared. And if, for example, following year end, the board of directors declared X amount of dividends, you will never go back and book a liability in 2019, even if the intention was existing as of 31 December 2019 or it's related to the financial year of 31 December 2019. Now, the big part of IAS 10 and which many preparers of financial statements forgot about is the disclosure part. So, financial statements for which an event, a subsequent event, whether it is an adjusting or a non-adjusting event, should always disclose any material fact. So the disclosures should include any, let's say, for example, subsequent to year end, a company acquired a new subsidiary which is material to the group. The group should disclose this fact in its financial statement. So thank you and have a nice day.